You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, well, we'll start by looking at last week's trade, which oddly enough, because we did it on Wednesday, turned out to be a fairly decent paper trade. We did it around Amazon's earnings, and we did something a little different. We did a ratio butterfly, and we used puts. We decided that we were going to be bearish on the market, but we did add additional risk. So this trade did not, it definitely looked scary on the open. Let's put it that way with Amazon. Amazon missed on earnings. A lot to do with the web services as opposed to the retail side of things. But bottom line is after the announcement, the stock dropped precipitously, and that did continue in the morning on the open. But on the open, it wasn't quite as bad as it was in the after hours. And the trade ended up if you would have set it up on Wednesday, based off of where the stock was on Wednesday, you would have came out just fine on the trade. But if you listened to me and said, well, I'm going to wait until closer to the close on Thursday when Amazon announced earnings and used all the planning that we talked about on the show, well, it would have been a much different trade overall. But still, it was hedged. It turned out to be an interesting trade. So let's go through it. All right. So on Wednesday, last week, the market was closed. We looked at Amazon. It was down $4.94 on the day. We went out and bought the October 28th. So that was this past Friday. We bought the October 28th 105 put, sold 3 of the 102 puts, and bought 2 of the 99 puts. So we wanted the market to get very close to 102. We did it for a net credit in the account of 6 cents. And Amazon announced earnings after the close on Thursday. And on Friday the 28th, the market actually opened at 97, 2 points below our lowest strike. So that makes you nervous. But then it traded up all day long. As a matter of fact, the high for the day was 103.96, which that makes us happy. And it ended up closing at 103.41, which actually makes us even more happy. So it was $1.41 in the money, for our 105 strike put. So if you did ride it all the way to the end, which once again, you probably should have received the stupid award if you did that and just let it ride all day. When it came back to that middle strike, you probably would have wanted to get out at that point in time. But if you rode it all day long, you were rewarded. You put the trade on for a net credit of 6 cents to the account. And if you stayed all the way to the expiration, you would have got something to the equivalent, if you were talking about exercise and assignment and all that stuff, of $1.41 or $141. So this would have been a trade that you put on for a credit to the account and then took it off for a credit to the account. So very interesting trade, especially if you were paper trading and watching the prices and watching how they changed throughout the day. You would have learned a lot about option pricing on that day. And it's a much different trade because we're selling 3 of the middle strike as opposed to a standard butterfly where you're only selling 2 of them. But to have it actually land within the wings, well, that's a pretty good day. We'll just leave it there. So I don't know exactly where it would have closed out at. I did not take a screenshot. It was a fairly busy day on that day. I intended to, but I did not. And let's just say, though, worst case scenario, you probably would have sold it for $1, put it on for a 6-cent credit, made a 106, and you had minimal risk on the trade from the way that we had it all set up, minimal and known risk, and away we go. All right, so we are now taping Options Playbook Radio. It is Wednesday once again, the 2nd of November. The markets are closed, and they were even more crazy than the markets were last Friday. The Fed came out and announced a 75 basis point hike in the Fed funds rate, and the market did nothing. Actually had a little bit of a move up, and then Mr. Powell started talking and said something to the effect that we are not in any hurry to start considering considering being more dovish on the marketplace. And then Mr. Powell came out and said that he was not in any hurry to stop or slow down on the raising of rates. He kind of paraphrased it. He really didn't say anything egregious, but the market took it that way, and the market tanked. From that point on, we saw all major indexes down. The Russell is down the most at about 3.3%. NASDAQ was just a little bit less than that. Yeah, I guess we would say 3.3% too. Let's just round it off there. And then we have the NASDAQ, or the S&P 500 index was down 2.5%, and the Dow was down 1.55%. So as far as the VIX is concerned, it actually ended up pretty much flat on the day. With that said, we rose, the VIX increased going into the Fed meeting, which was at 2 o'clock. After the announcement, we saw the VIX come down and trade near the lows of the day, down close to the 25 level. And then we had the big downturn, and now we see the VIX at 25.86. So, oddly enough, I would have expected the VIX can actually spike, but the highest point for the VIX all day long was around the noon hour, right around 2660 is where the VIX actually peaked out at. So even though we had a downturn in the S&P 500 index of 2.5%, the VIX actually came off and is trading lower than it was around noontime prior to the Fed announcement. All right, so let's get into this week's trade. Obviously, with the markets and what happened today, it is hard to try to get bullish on anything. The way the markets are leaning right now, if you would look at consumer staples, maybe dollar stores, those type of things, which a lot of those stocks are hard to trade options on just because of the liquidity. So I just decided to grab the Russell 2000 ETF, which is the IWM, M as in Mary. That is the most popular ETF that tracks the Russell 2000 index. And as I mentioned, the Russell 2000 index was down 3.36%. I don't know if I was as exact as that. That was down 62 points in the Russell 2000, which is obviously the small caps. And I think we're just going to lean into the momentum of the markets being down. And let's look at buying a long put spread in the Russell 2000 index. And I'm going to look at it in two different ways. If you transferred your portfolio over to small caps, which it kind of makes sense in an environment like this. If you think the U.S. economy is doing better than overseas, the Russell 2000 index would make sense to try to protect yourselves because most of the smaller companies only do business in the U.S. Not all of them, but most of them do. So you kind of limit your exposure to the overseas economies, which are definitely not doing as well as the U.S. economy. So with that said, Russell got beat up today. If you wanted to protect your portfolio, this is one way to do it also. You can go out and actually, you could buy puts in the Russell 2000 index. If you had a fairly substantial amount of small cap stocks in your portfolio, in your accounts, that's one way you could do it. Or you could do this long put spread. So I'm going to build this today more as a speculative trade. We're going to go short term. We're going to kind of see where we land here. And hopefully when we get into the holiday season, maybe the consumer can save us and we can get some holiday sales that can drive the market. Hopefully they'll continue to spend and keep the market at least where it's at, if not start creeping higher and get a Santa Claus rally into the end of the year, which happens actually after Christmas. It's between Christmas and New Year's is basically the period that they call the Santa Claus rally, and a few days going into the New Year in January of 2023. Okay, so let's just set it up. Let's be short and sweet about this. If I go and I look at the Ally Invest option chains, we see right now the Russell 2000 index, or the IWM, which tracks the Russell 2000 index, last traded at 177.49. It's down $6.09. So 177.49, down $6.09. I'm going to go out to November, right before the holiday period kicks off. So we're going to look at the November 18th expiration. It currently has 16 days remaining to that expiration date. I'm going to go a little bit out of the money. If I'm using this as protection, you think of it as I'm going to buy, have a little bit of a deductible before my insurance product kicks in. But in my instance, I'm going to go a little bit out of the money because I just don't want to spend a lot on this. I'm going to give myself a good amount of upside. We have a fairly big skew in the puts. In other words, the more at the money option contracts are trading at a lower volatility than the out of the money contracts. And that happens a lot when you have a big down day in these indexes. You have a tendency to see the out of the money put implied volatility increase. Some people will call it a volatility skew, and that's just common in general. But we are in an ETF which tracks that index, but it still applies to the ETF. So in this instance, we are going to do a fairly wide spread. We're going to buy the 175 strike put with the market currently trading at 177.49. We're going to go 10 points down, and we're going to then sell the 165 strike put. So I made the strikes easy to remember, exactly 10 points wide. The 175 strike put was trading very tight markets in the IWM, but it's trading 363 by 367. So even with the markets closed, we're still only 4 cents wide. And we're getting a ton of premium for the 165. So the difference in volatility is about 2 percentage points, and that equates to higher implied volatility on the 165 strike. We're currently showing that option contract trading 98 cents by $1. So if we buy this out of the money put spread, we can get it done for a fairly low cost, mainly because of the way that the skew is in the put options. But we can get this done at a midpoint price for $2.66 or $266 plus commission on our paper trade for this week. And so we're buying 1-by-1 long put spread, otherwise known as a bear put spread, in the IWM going out to November 18th expiration, buying the 175 strike put, selling the 165 strike put. Our maximum risk on this trade would be $266 plus commission. Our upside would be the difference between the strikes, minus 266. So we have the difference between the strikes is 10 points. And if you take 10 minus $2.66, you come up with $7.34 worth of upside. The only way that we would achieve that maximum is if closer to the expiration date, we were actually down by the put that we're selling, which is the 165 strike put. So quite simple in that we did an earnings trade. We did okay on an earnings trade on Amazon. Always feel appreciative when at the expiration of the option contracts on a butterfly that the stock actually stays within the strike prices, within that landing range. That's kind of hard to do, especially around earnings. So always happy when that happens. And then in this situation here, just almost punting, saying, I don't know if there's anything that I really want to be buying right at this point in time. I kind of mentioned some of the low-end retailers would be fairly interesting, maybe even some of the grocery stores. Everybody kind of needs to eat, so those would be a couple of things that we actually looked at in our weekly viewpoint, but I just don't want to get bullish on anything. So let's look at a bearish trade. You can think of it as an insurance policy if you would like to try to protect yourself against downward movement in the marketplace, or just pure speculation on a shorter term trade, thinking that this trend might continue going out for the next couple of weeks. And that's it for this episode of Options Playbook Radio. If you have any questions you'd like us to answer, please email them to me at theoptionsguy@invest.ally.com. If you want to learn more about the educational events at Ally Invest, please just follow me on Twitter. My handle is @BrianOverby. And that's it for this episode of Options Playbook Radio. Until the next time, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.